My name is Stephanie.
My name is Catherine.
My name is Greg.
My name is Gabriel.
And my name is Emery. At Iconic Footwear, we are shaping a future where innovation meets quality. Join us in creating transformative solutions, fostering growth, and making a difference in the shoe industry. Together, we are redefining possibilities and inspiring greatness. Iconic Footwear's focused differentiation strategy encompasses redefining the art of footwear by seamlessly blending timeless craftsmanship with cutting-edge technology, creating high-quality lifestyle shoes that not only elevate fashion, but also prioritize comfort and durability, setting new industry standards and delighting our customers worldwide. In the competitive landscape of the business simulation game, where numerous virtual companies vie for market share, the ability to redefine an industry is a significant advantage. Our team is narrowing its scope, allowing for deep specialization and expertise. Our emphasis on fashion, comfort, and durability aligns with the evolving consumer preferences. In this game, this approach can translate into higher customer satisfaction and loyalty, leading to repeat business and positive word-of-mouth marketing. In the inaugural year of our business simulation game journey, our team strategically positioned itself as a best cost provider, aiming to deliver exceptional value to customers by not only meeting, but surpassing their expectations in crucial product aspects, such as quality, features, performance, and service, all while maintaining prices below what they anticipated. This strategic vision was grounded in the understanding that in the competitive virtual market, customers seek products that offer superior quality and performance at an affordable price. By excelling in both product quality, as reflected in our SQ rating, and customer satisfaction as evident in our low reject rate, we established a solid foundation. However, challenges emerged, notably excess inventory and high manufacturing costs, which demanded strategic interventions. To leverage our strengths and address weaknesses, we identified opportunities in market expansion and model availability, areas where our team could capitalize on consumer demand and streamline production efficiency. Despite our strengths, the ever-present threat of competitors with similar strategies necessitated continuous vigilance and adaptation.
As explained in our current strategic vision, our Year 14 competitive strategy of choice has become focused differentiation. During Year 14, we focused on having a high SQ rating and reducing production costs by shifting production from North America to Asia Pacific and Latin America. We also recognized our market share in Europe, Africa, and Asia Pacific was dwindling. We focused on Latin America, where we employed celebrity endorsements to continue having a strong market presence. We made the cost-effective decision to abandon our North American production facilities to help reduce costs. Despite our decreasing production in North America, our net revenue showed continued growth year over year, as well as exceeding the industry's average. We began to add production capacity in Latin America to offset the reduction in production in North America to keep up with our demand worldwide.
Earnings per share is a financial metric that measures our profitability in a per share basis. Change in EPS are closely tied to various factors within our company's financial performance, including revenues, cost, competitive strategy. You can see in year 11, we were able to increase revenues, and the company adopted a successful strategy by expanding production and increasing sales, including private label. In year 12, we had a sharp drop in EPS and a decrease in revenues. Overproduction caused significantly lower profit margins due to the fact we did not pay enough attention to sales projections in each geographic area. In year 13, we focused on growth in Latin America and more accurately forecasted sales for improving our production numbers. And finally, in year 14, we focused on repurchasing a significant amount of stock with cash outlays. Changes in EPS are often due to market dynamics. We'll continue to focus our efforts on accurately forecasting market trends to improve our EPS. Iconic Footwear's stock price is a function of revenue growth, earnings per share, ROE, credit rating, dividend per share growth, and management's ability to consistently deliver results. In our case, stock price has essentially mirrored our company's EPS. we plan to focus on 3 key elements: increasing revenues and net profits, continuing to increase dividend payout annually, and continuing significant stock repurchase each year to improve investor sentiment.
We believe that Cloud Athletics is running the same focused differentiation strategy as we are. After analyzing their business, we believe that they are choosing to run this strategy because they are focusing on a high SQ rating and high model availability in the shoes they manufacture. Cloud Athletics seems to be focusing on producing a high-end, high-quality shoe. Since year 11, Cloud Athletics has pushed for increased model availability quicker than we have, and this has helped them build up their SQ rating as well as customer base in North America. Cloud Athletics has also been able to successfully hold a higher SQ rating than we have since year 11. We believe that Cloud Athletics is a highly effective competitor. It seems both companies had similar ideas when it came to decreasing production in North America market. The difference between the two companies is the market we chose to move into. The actual breakdown of the different production market differences will come a little later in this analysis. Again, in the Latin American market, we notice that Cloud Athletics has increased their SQ rating quicker and held that advantage over us in this market. Cloud Athletics increased their model availability quicker than Iconic Footwear in years 11 and 12, but in year 13, we were able to surpass their model availability as we began focusing on a fast ramp up of production in Latin America. Since production was moved into the Latin American market, our company also concentrated on celebrity endorsement contracts for the individuals most popular in Latin America region. One major area of difference between our market strategies has been the fact that Cloud Athletics has continuously moved to increase production in 2 global markets, while Iconic Footwear has concentrated on expanding in 1 regional market. The market we chose to expand in has been one of our major downfalls to the company being able to be as competitive as Cloud Athletics. Another area we have noticed that Cloud Athletics has successfully been able to outplay us is their image rating. Since year 11, Cloud Athletics has had a higher image rating than us by a maximum of 18 points and a minimum rating difference of 7 points.
In year 14, Cloud Athletics has the greatest quantity of production in the Asia Pacific and Latin America markets. In a parallel manner, both Cloud Athletics and Iconic Footwear have decreased production in North America, as Stephanie mentioned. However, Cloud Athletics has achieved a larger quantity of production sooner than us. In fact, across all companies within the industry, Cloud Athletics holds the greatest production quantity in the Asia Pacific market. Another interesting metric from this analysis is the difference in the amount of time stock is kept on hand between both companies. Cloud Athletics moves their inventory in 42 days on average, while we hold on to our inventory for 49 days on average. This can be attributed to Cloud Athletics' greater use of private label sales. A final similarity between both companies is the use of celebrity endorsements that match target markets. Specifically, Cloud Athletics secured endorsement contracts with celebrities who had popularity in Asia Pacific and Latin America markets. Contrarily, we secured celebrity endorsements for Latin America only. Overall, both companies produce similar PM, OPM, and net PM data trends. Earnings per share is the net profit divided by the number of shares outstanding. This captures the profitability of a company and reflects the value a shareholder places on owning stock. We fall within the top 4 companies ranked according to EPS for years 11, 13, and 14. In year 12, investments were made to purchase space for equipment in Latin America. This impacted our overall EPS by reducing the profit for the company. Going forward, we can strive to continue increasing profit and continue to repurchase the maximum quantity of shares allowed each year, as these actions manipulate EPS drivers in our favor.
ROE is the net income divided by the average amount of shareholder equity. We were looking at what we needed to do to boost our ROE and exceed the investors' expectation for us. From year to year, we focused on the repurchasing of stock, boosting net income, paying attention to best practices training, and increasing the price of our shoes. We have put forth more effort into repurchasing stock as the years have progressed. When making financial decisions, we have decided it's in our best interest to repurchase the maximum amount of stock we can. Now that we have been producing in the Asia Pacific region as well as Latin America market for a couple of years, and they are both established markets, we have decided to slowly decrease the amount of money we are spending in our best practices training in those areas. From year to year, we have decided to increase the price of our shoes. We do not want to increase the price drastically from year to year, but we do have to increase them slightly to help cover the manufacturing and material cost of our shoes. We plan to keep our prices fair and close to industry average, if not just slightly above. The price increase helps us to increase our net income. One thing that we have not done yet, but have the option to do in the future if necessary, is slightly decrease the amount we are spending on our TQM Six Sigma quality program. Since we are focusing on gaining a high SQ rating to help with our differentiation model, this option will be the last option to decrease to help us gain ROE. Most important drivers of our team right now are we need to keep up with inventory demands while making sure we are not overproducing stock. Our main goal is to increase net income while delivering a superior product to our customers.
Iconic Footwear stock price is measured by a percentage of five-made performance targets in the BSG game, which are revenue growth, earnings per share, return on equity, credit rating, and dividend per share growth. Right now, our most important drivers for the team are substantial growth and continued expansion in Latin America and Asia Pacific to increase revenues and net profits. Number two, continue to increase dividend payout at a minimum of 10 cents per year. And lastly, significant stock repurchase each year when possible.
As you can see, we strive to maintain a high credit rating. The most important drivers for our team right now regarding our credit rating are the reduction of debt and the increase in our assets. We are well within the industry's average for low risk. This is important as we want to maintain a strong credit rating to reduce our interest rate for any future borrowings.
Image rating meticulously assesses a company's reputation among customers, competitors, and stakeholders. Image rating serves as a critical barometer in the business landscape, encapsulating the collective sentiments and judgments that customers, competitors, and stakeholders hold about a company. It goes beyond mere financial metrics, delving into the intangible, yet profoundly influential realm of public perception. A high image rating signifies trust, credibility, and customer loyalty, paving the way for the increased market share and sustained growth. Conversely, a poor image rating can lead to diminished customer confidence, reduced sales, and challenges in attracting top talent or forging strategic partnerships. Key drivers here include customer satisfaction, innovative business practices, marketing, competitive pricing, effective communication, and product quality. For our team, three stand out. Innovative business practices, competitive pricing, and product quality are paramount. They showcase our forward-thinking, timeless craftsmanship, and commitment to quality, shaping a strong and positive company image. In our 3-year strategy for the remainder of the game, a crucial focus lies in balancing tariff and labor cost effectively between the Asia Pacific and Latin American markets. Currently, the tariff rates per pair stand at $8 for Asia Pacific and $10 for Latin America. Additionally, when considering annual average total compensation for workers, Asia Pacific is lower at $16,064, while Latin America is slightly higher at $16,482. One significant factor affecting our bottom line is the negative 7% revenue impact by shipping out of Latin America. To ensure sustainable growth and profitability, it's imperative that we assess and optimize our production and shipping strategies, taking into account these varying costs and market dynamics. By carefully managing these factors, we can enhance our competitiveness and maximize our profits in both the Asia Pacific and Latin American regions, contributing to the overall success of our business simulation.
Looking forward, there is a significant gap between our performance in the Asia Pacific market and Cloud Athletics. The drastic difference in celebrity endorsement that exists prevents us from making moves into the Asia Pacific market. We do not believe that we would be able to catch up with the significant lead Cloud Athletics has established. This said, we can continue to utilize private label sales in both Asia Pacific and Latin America markets as we continue to see successful sales in both. This is made possible by prioritizing the movement of product rather than profit. Our strategy so far has been to use an extremely low profit margin, such as 1 cent, to ensure our shoes are sold. This has allowed us to sell more private label shoes on average than Cloud Athletics in both markets, despite the superiority of Cloud Athletics in the Asia Pacific market.
Iconic Footwear has been very keen on investing in new equipment into our existing business models because of the drastic change in buying patterns of the consumers. With the necessary expense of the new equipment, Iconic Footwear decided to place the new equipment in Latin America to take advantage of the lower wage rates, thus making our shoes cheaper to produce and ship globally.
We've learned several lessons in the first few years of the game. A few include reading the player's guide and fully understand strategy first, specifically how it takes a few years to reap benefits from retailer support. We fell behind in retail outlets offering to sell our shoes by not purchasing enough retailer support in the beginning. Consider and evaluate all logistical costs in every market. This includes tariffs, exchange rates, labor costs, etc. When we expanded into Latin America, we did not properly account for the high exchange rate. Third, keep production in line with demand. Not accurately forecasting demand will lead to extra shoes and unsold inventory. Last, strategic models can and should change. Understand you and your company are making decisions based on how you anticipate the market will perform and react. If you can accurately forecast market performance, you and your company will be able to make educated decisions. We're excited for the progress Iconic Footwear has made to date and look forward to continued success in sharing our progress after year 17. Thank you.